Hi, and welcome to the Macro Show. We talk macro, and you wonder, not even stimulus can stop deflation? We've got that. We've got the economic data, Richland Fed data, auction data. And we got to really talk about today's Fed presser. I mean, it was kind of going to be kind of benign, and there's actually some interesting stuff in that. Plus, I've got a special announcement out at the end. I'm your host, Steven Van Metre, and thanks for joining me today. Let's get right into our headline story. Is what's going on? Why isn't stimulus causing inflation? You say, well, whoa, time out, Steve. CPI is going up. Yeah, it's called base effects, my friends. But when we look at the money multiplier, it really tells us what is more likely to happen. When the money multiplier is rising, it means you have a higher probability of getting inflation. It doesn't mean you'll get it. It just means you have a chance at it. If it's falling, well, it means disinflation or deflation is prevalent. And unfortunately, we only can now get the money multiplier once a month because we only have the money supply data and the monetary base data once a month. Now, with that, we have to kind of dismiss this myth that the Fed canceled doing the money supply. That's not true. It's just monthly now. All right, so we're in this black hole, this liquidity trap, and we're swirling around. The economy is swirling around this black hole, and the black hole is getting bigger and bigger and bigger when you see the money multiplier fall. And now, how do you get out of that? I just kind of want to revisit how we get out of this liquidity trap. And first, number one, the Fed can raise rates or do quantitative tightening. Yeah, it's not going to happen. We'll talk about, for sure, we know that. We'll talk about, the presser here in a little bit. You have fiscal stimulus. Now, everyone thought, okay, if there's a lot of fiscal stimulus, and we just had a whole lot of fiscal stimulus, and based on data I just saw today, that about 85% of checks are out. So I know a lot of them went out in March. We got a bunch more of them probably went out in April, and maybe a few that are going to be, at the end of this week or going into May. And didn't do, I mean, it drove consumption up, it drove prices up, but it's transitory. It's not driving broad-based inflation, and nor is it actually doing what we needed to do to turn the money multiplier story around, to actually shrink that black hole. We want to shrink it, not expand it. We're expanding it. And the last one is lending growth. And how do you get lending growth? Well, we're already in a lending contraction, as we've talked about. And the only way you get that is lower rates. So let's take a look at the money supply. And here it is on a year-over-year rate of change is now down to only a mere 24.24%. And now we'll go over to the monetary base, also monthly. It's growing at 50.37 or 50.4. Now, in the liquidity trap that we've talked about, when the growth rate of the demand for money is proportionally larger, so it is, right? Demand for money, just so we're clear, demand for money right here is growing more proportionally than the supply of money, which it is. You get A, inflation, B, disinflation, C, deflation. Well, you get B or C. You get disinflation until, the black hole gets big enough and the economy swirls right in and goes down, and then you get deflation. So let's take a look at the money multiplier, and what you can see is that is not it. Here it is. It's simply taking the M2 money supply divided by the monetary base, making a little mathematical adjustment so you get your decimals in the right spot. And what you see, and this is much to my surprise too, my friends, we went from 3.6 to 3.4. Look, I really thought that due to all this fiscal stimulus, the money supply would grow a lot more than it did. And what's interesting to me is in March, because this is March data, is if you remember lending growth, it was kind of falling. It zeroed kind of it hit the 0 point at the end of March. We entered the contraction in April. So the really question is that as good as it gets? At this point, are we now only going to see the money multiplier go down? And when the money multiplier falls, it is a sign of disinflation. It falls enough, it gets outright deflationary. And if you want to think about recessions, remember, in 2016, the stock market wasn't doing that hot. Why? Because, by mid-2014, 2015, the money multiplier was terrible. It was in a bad place. And of course, ultimately, that leads to a dollar shortage. And so what we're going to find out is this has broad implications on the economy. If we look at the consumer price index, on a year-over-year rate and overlay it, the consumer price index is at 2.64, 2.6, and you can see that there are times when the consumer price index rises here in red as the money multiplier falls. And what happens? Well, one's got to come back to the other. Well, we know the money supply is not growing fast enough. And so what does that mean? These transitory base effects, as Powell talked about, are going to get unwound, perhaps even more than people think they're going to get unwound. You can see here the CPI came crashing down, and here you can see the CPI came crashing down. This is one time that the money multiplier was rising. And again, just because it's rising doesn't mean you get inflation. It just means you have a higher probability of getting it. Well, we didn't get it, and so now you see CPI going up, money multiplier going down. Tells you that the CPI, while it can still go a bit higher, it is likely to turn around and go lower. It also, and so when you think about that, what does it mean for these higher consumer prices, right? We know food prices are up, we know energy prices are up, but what does that mean broadly? It means they're going to get rejected because there isn't enough money. That's what this is saying. They're saying money is getting trapped in the financial system. The volatility is getting compressed down. It can't move. And so when that happens, it's very disinflationary or deflationary. So higher prices ultimately get rejected, and that's why you see the consumer price index fall. Now let's go on and take a look at the labor force participation rate. Now I just cut out the money supply because, well, the labor force participation rate, which if you don't remember is the percentage of people, of able-bodied people that could work, that are either working or looking for a job. And, well, the labor force participation rate's pretty low. It's at 61.5. And pre-pandemic, you could say it was in the 63 to, low to mid 63% range. And you can see due to the relationship of the monetary base, which is heading lower, it suggests that due to tight financial conditions, there isn't enough money, and that as people go back to work, right? So what we're seeing here is people are going back to work, the stimulus checks are getting out there, they're flooding the economy, and then what's going to happen in, maybe starting this month, next month, the month after, as we go through and the stimulus runs its way through the economy, these jobs are going to be a revolving door. People are going to find out the demand isn't there and jobs are going to get lost. And that means people are going to start giving up on looking for a job. And that is how you see the labor force participation go down, is not only are there fewer people working, there are fewer people trying to look for a job. And we can even say, well, how does that apply to interest rates? Because, the broad view right now is interest rates can only go higher, and they must go higher. They must go significantly higher. They're so low they can only go to somewhere beyond infinity. And the reality is, if you take the monetary base and invert it, by the way, it was inverted in this chart too, and you overlay a 30-year treasury yields, what you find out is that tight financial conditions, as indicated by not only the money multiplier, but a rising monetary base, indicate that interest rates are more likely to go down than up. In fact, that may be one of the biggest reasons why we're seeing a peak here, which everyone's saying right now, no, this isn't a peak, this is temporary slowdown on our way higher. Well, it could be just the exact opposite, saying that, look, financial conditions are tight because it come back to how do you get out of this liquidity trap? Either the Fed reverses policy, not going to do that. We get more fiscal stimulus, probably not going to get that. And look, we just had a big fiscal stimulus that's not working. We just see it. We're seeing it not working. You see the data for March. It did not work. And maybe April will be better, but I can't imagine it's going to be that much better. You got to get lending growth. Where do you get lending growth? Do you get lending growth when rates go higher or lower? Right. Nah, tricked you. They go down. Yeah, right? They go down. Actually, I moved the wrong hand. To see it's mirrored, so it's my bad. Okay, so let's go on to the economic data and see what we got going on here. Coming back to Tuesday, Japan, core CPI, Bank of Japan, core CPI, excluding food and energy, 0. So no inflation. None. Zilch. That's not what you're looking for. Let's move on to the U.S. data on Tuesday. Red Book year over year. That's continuing to rise. Probably a lot of base effects. We're not even seeing the month over month or the week over week data because, well, it probably hasn't caught up to stores reopening yet. Home prices continue to rise. Many of you know that, and then some of you also know that I think that will also be transitory at some point. That will turn out that tight money, right, that you get from the money multiplier right, will ultimately lead to lower interest rates because, even though Powell said it doesn't look like there's any problems in the real estate market. Well, look, when you don't have enough money and there's a lot of debt, it's like musical chairs. Someone can't pay their bill. So that is to come. Housing prices still, though, pricing people out of the market, 12.2. Some of you are thinking, will I ever own a home? Hang tight. You'll get your chance. Don't worry. Nothing ever goes up forever. Consumer confidence survey from the Conference Board in April up to 121.7. Do keep in mind, this is a lot of these consumer confidence surveys are more a proxy of the stock market. When the stock market is up, you're going to see these surveys up. When the market's down, you're going to see them go down. And all we see here is this is catching back up to the market not catching down to it. How about the Richland Fed Manufacturing Index? Printed 17, same as the prior month, meaning it expanded. The manufacturing sector in the Richmond area, Virginia, expanded at about the same rate as it did in March. And we look at the services index, expanded at a little bit faster rate. Let's take a look at a little bit of the details here. And let's see, it says 5th District manufacturing activity improved in April, according to the most recent survey, indicating continued growth. Well, that was true. And let's take a look at the current conditions. And what are we seeing, right? Shipments, up from February, but unfortunately down from March. So you see shipments have slowed a bit. They're still up, but the rate of their growth is slowing. New orders up. Now, this doesn't make any sense because we saw durable goods new orders completely miss in March. And now they're saying in April they're going to get better. I think some of these diffusion indexes are not even close to accurate. Backlog of orders is increasing. Normally, this is where you actually see inflation is in the backlog. Capacity utilizations is how much of the factory is being utilized, up a little bit. Vendor lead time is really high. Local business conditions slowed a little bit. And what's the real thing we're looking for? How about wage increases? Well, they're seeing that firms are talking about wage increases, so 33% of firms were looking at that. But what about inflation, right? Prices paid up 7.11%. This is year over year data. How about prices received? Up 4.83. So what you're seeing is they cannot pass these higher prices on. Now, they got a little bit of more juice out of it. There's a 1% increase on the year over year from the prior month, and about 1.25% or so increase on prices received. But you can see manufacturers are what's called getting squeezed at the margin. They're not able to pass these higher prices on. And ultimately that will be a problem for profits. And let's take a look at the services sector, mainly interested in the same information. Let's see, prices paid up 4.79% from a year ago. Prices received, look at how big the 2.78%. I mean, they're not even close. So what you're seeing is the services sector is really taking a hit here, and they've got pressure. They're being forced to add a bit of employees. 12% of firms said we're adding. 30% of firms said they're increasing wages, and yet they can't pass those higher prices on. That is going to be a big problem at some point. All right, we got the 7-year note auction, which we already talked about was going to be okay, and it was okay. We had a bid to cover ratio slightly below the 6-month average. I think that was not really a big deal. There was plenty of demand from direct bidders and indirect bidders. Overall, good auction. There was no low bid at zero. No, not really a need to. I mean, the 7-year has gotten so much bad press. There was really not much. I mean, if you were bidding on that, you wouldn't put in a low bid because you didn't need to. Now, I don't know what's going on in Australia, but what is interesting to me is the year-over-year first quarter CPI came in below expectations. Was targeted at 1.4, came in at 1.1. So it's kind of interesting to me that here you have a very resource-heavy, commodity-driven economy, and it's not seeing the inflation you would expect it to see. Could that be foreshadowing what's coming around the rest of the world? Could be. How about into the U.S. data today? Mortgage applications down 2.5% after a big pop the week before at 8.6. And something that's interesting to me is you have wholesale inventories. Now this is preliminary, and you'll notice in this chart these are month over month. And so what have we been hearing? Inventory levels too low, too low, too low, too low. And what are you seeing? Inventory levels building month after month after month on the wholesale level. Well, that's odd. I mean, why are all these manufacturing diffusion surveys saying otherwise? Well, how about retail inventories excluding autos? And of course, we know there's going to be issues in the auto space because of chip shortages. But look, 1, 2, 3, 4 months of month-over-month builds in retail inventories. But yet you're hearing shortage of inventories. What I am wondering here is, as the economy reopens and more people get vaccinated, if that's what they're choosing to do, and the supply chain stuff starts to get worked out, are we going to have too much inventory? I mean, is this one of those cases where retailers and wholesalers are literally bought into the view that there's going to be this huge amount of demand, so we better stock up, and yeah, we have some inventory, but we need more. We better order even more than that, and you know what, just in case, let's get some extra because there's a lot of lag. I mean, is that what this is? Are we going to have it, in a few months down the road, as the stimulus checks dry up and go away, as this tight money conditions really become prevalent, that there isn't any demand, and then you have an inventory shock? Could be. How about today's crude oil data? Actually pretty positive. Imports were up quite a bit, and yet broad oil inventories were only up 90,000 barrels. Cushing inventories up 722. Here's something: if you're looking for economic demand, look at distillates. Think of this as jet fuel and diesel fuel, down 3.34 million barrels, so that's positive. Gasoline inventories up only 92,000 barrels. If you look at the refinery runs, they're running a little over 85%. So you're seeing pretty good demand here from the distillate sector, and that is what you want to see in a reopening economy. All right, let's talk about the Fed. Okay, so I was on. I was clear. Well, I don't think I talked about this show, but I did mention a couple days ago to someone. So I was on record saying, yeah, this is kind of a nothing burger, but it's actually pretty interesting. There's a couple points that I want to show you, and let's go right to the Fed presser. And here's their statement: inflation has risen, largely reflecting transitory factors. Now, I caught this as a little bit different wording, but in so there's two parts of the presser. There's usually a part where Powell's reading, something he's pre-written, and then he answers questions. Generally, the pre-written stuff, you can get right off of that. Mostly, it's not that interesting, but sometimes he ad-libs a little bit. It's a press conference where things get really interesting. But this is something he said in the first part of the press conference when talking about when they're going to potentially talking about tapering. And see, this is so bad that we have to have a talk about the talk. When are we going to start talking about the thing that we might actually talk about to actually do? That's how bad things are. And a lot of people think that this taper is the pre-talk is going to start happening in June. The actual taper is going to be in January. I'm saying no way. I mean, you can look at the money multiplier and go like, this is not going to happen. This is not going to happen at all. And so, there was some mistakes from the last FOMC meeting, and that was that Powell did not make it clear what he meant by this 2% inflation targets, or this above 2% inflation target, because we had the 1 month, right? 2.6% CPI. Okay, there it is, start tapering. And no, so he had to fix that. And he had to go overboard, and he made it clear when he was talking about, what it would need. He said, quote, a transitory rise above 2% this year. Let me say it again. A transitory rise above 2% this year, 2021, would not meet this standard. So he's saying, look, folks, I know the CPI went over 2% in March. I know it's probably going to go over 2% in April. And it might even go over 2% in May. But that ain't enough. It's got to do that more. He said above 2% this year. Now, he later went on to clarify during the Q&A, what these base effects are adding on. He said they're adding on a 1% year over year. So if you took the base effects off for March, take that 2.6 down to 1.6%. So what does this mean? April, we know, is going to be print a little higher. May, possibly. June, no chance. None. And so he got asked, what would it take for you to have the talk about the talk to taper? He said, well, I want to see the labor market at full employment. They asked him, what was that? He says, well, we're 8.4 million jobs short. So what is that telling you? Is if you think the Fed's going to start tapering, you need to see them get really a lot closer to that 8.4 million mark, with the expectation that in the coming 2 or 3 months after that, it's going to hit that mark. That's what he's looking for. And when he was pushed on that, he said, look, the concern I have is in the services sector. A lot of companies have, bought software and automation and streamlined their processes. He says those jobs aren't coming back. And so this is going to take longer to get, new jobs created and find work for them. That's very interesting. And he also said he wanted inflation at 2% consistently heading higher. Not 1 month, not 2 months, not 3 months, consistently boom, boom, boom across the board. And he was very clear. He said inflation is not an event. This is, what we're seeing here is these base effects from an event. Inflation is something that continues to build and build and build. So Marcus talking taper in June. Steve's saying, yeah, right. And Powell is saying, look, I need to be really clear. It's going to be a while. I'll let you know way ahead of time. We might have a talk before the talk that we're going to have about tapering. Let's go on to the rest of the report before we get into the special part that I was going to show you. Here's the implementation note. So the excess reserve are going to be paid at 0.1%. That's not changing. And they're going to maintain the federal funds rate. That didn't change. They're going to continue buying $80 billion of treasuries and $40 billion of mortgage-backed. That didn't change either. Nothing here changed. But one of the questions that's come up is, hey, Steve, did you know the Fed's balance sheet's increasing at a rate faster than what they're saying? Let me show you why. And it says here, roll over at auction all principal payments from the Federal Reserve's holding of securities and reinvest all principal payments. More importantly, from the Federal Reserve's holding of agency debt and agency mortgage-backed security and agency mortgage-backed securities. So what's happening is the Fed's buying $120 billion a month, but they're receiving interest on their entire balance sheet. What is it, 4 or 5 trillion? I don't remember where it's at. Now, I don't know what their average rate is. It's probably close to 1%, because remember, a lot of Fed's balance sheet before was in T-bills. And so now they've been adding coupons, but coupon rates are relatively low. So what does that mean? Is in addition to the $120 billion a month, they're taking about 1% of their balance sheet per year, split monthly, and buying more. That's kind of helping with it, but it shouldn't be a substantial amount. It shouldn't be much to get too excited about. All right, so as we go into the special announcement, now many of you remember we put out an issue of Momentum Timer Pro. I've been meaning to do another one. I haven't had a chance. And while a lot of feedback was very positive and some of you were very helpful, like, hey, here's how to fix this, here's to change your layout, some of you great creative people have great eyes and you really know how to, brilliant minds in terms of making user-friendly designs, and I appreciate all your feedback. The one thing everyone says they want timing, stock picks, or not stock picks, but I want to know when to buy and sell stuff. All right, well, let me show you the beta edition of the new version of Momentum Timer Pro. And here it is. Now, just so you know, I'm not posting this on the website. I have compliance approval, tentative approval to continue working on it. But the idea is you'll see symbol, name, daily, weekly, monthly. So I pulled all the signals together, created a kind of a scorecard. It should say, neutral, buy, strong buy. Sell signal. It's got strong sell somewhere on here. Here you see a strong sell. It's got U.S. equity ETFs, foreign and emerging market ETFs, bond ETFs, inverse commodities, currencies. It's got a whole bunch of stuff. And right now, our friend Travis Kimball is beta testing this. So he's supposed to be giving me feedback. Travis supposed to be giving me feedback. And so compliance is reviewing this to see, like, hey, is there any problem with, sending out broadly? And the idea being is, once Travis helps me work through, like, okay, this is what needs to be improved, and compliance gives me a green light, I'll set up a web page and you can sign up for free. I'm going to send it out for free for months, who knows, however long. And if it turns out to be something of interest and everyone likes it, we'll go to a low cost paid edition with the same data. And if it's not of interest, I will get rid of the whole thing. But anyways, I wanted you to know that, so many of you have said, I want something that gives me timing signals. Well, there you go, my friends. Hopefully coming soon to a place near you. And with that, thanks for watching. Thanks for being fans. I'll see you back on Friday, of course, for the macro show. I'm Steve Van Metre. Bye now. The content of this video is provides educational information only. Is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation by a selling security, financial instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.